let's move on to another household and personal products company called Kenvue. And I wonder where this name came from. It sounds like a Kleenex, but it's Kenvue. I'm not. You ever hear what it means? I don't think it means anything. I don't know.
No, I don't think it's like Kleenex or anything. I don't think there's a use case for Kenvue.
Well, Kenvue is a company. That's their name. Their symbol is KVUE. They are in the household and personal products industry. Only 2.2% short on it. We do see the PE ratio doggone it, like 39.3. Well, we talked about the bubble. We may not be able to find many things here, but the PE ratio for Kenvue is 39.3 versus 26.9. Price to sales 2.8 versus 2.7. Price to book value is better, 4.2 versus 5. But price to cash flow is also more expensive than the industry at 22.2 versus 17.4. And the PEG ratio, no deal here, 17.8 versus 22.3. PEG ratios, we generally like them around 2 to 4, probably at the max there. We do see that their earnings are down last year, 1.8%, but the industry only up 0.3. Sales are down 1.1%. Industry was down 0.5. 5-year earnings per share growth estimate from the analyst, 1.1. The industry is at 4.5, so nothing really great there. They do pay a decent dividend, 3.7% is their dividend, but they use 145% of the earnings to pay that out, so that's a little bit concerning. And even free cash flow, they use 108.8%. The balance sheet, you got current ratio 0.9 versus 1 for the industry. I'll say that's okay. Debt to equity is 0.9 also versus 3.6, so that is a positive. They do have a lot of intangible assets, 67.5% versus 41.1% for the industry. And we see net profit margin, not that great, 6.9 versus 10.2. Return on equity also some concern here as well, 10.5 versus 25.5. Free cash flow, $1.4 billion. That does pale in comparison to the industry. Free cash flow was $7.7 billion. Just not finding anything great here. What do you got going for it, Chase?
So current price here for Kenvue, again, their ticker symbol KVUE. Well, it's $22. 52-week range, the low here, $17.85. The high, $25.17. And while you may not recognize Kenvue, I'm sure you recognize some other products. And they were spun off from Johnson & Johnson actually in 2023 is when that was completed. But their products include Tylenol, Motrin, also too they have Benadryl. They then have Neutrogena, Aveeno, Lubriderm, all kind of the personal skin health brands. And then lastly, this one I always like to see, Band-Aid.
Band-Aid.
There's one that you talk about, Kleenex, Band-Aid.
Band-Aid. And Band-Aids have gotten so much better over the years. I mean, they blend nice. They hold up underwater. They're just, Band-Aids have had a big improvement.
Well, it's funny because it's like there's other Band-Aid brands out there too, outside of just Band-Aid, but it's like, you call them Band-Aids even if they're not made by Band-Aid, you know. So I don't know if you're using Band-Aid branded bands or
using Band-Aid fake brands. I don't know.
Who knows? But also they have Listerine is another one. So I mean they have these well-known products.
I use that product too.
Yeah. Going forward though, I mean this is kind of the issue that we talk about with a lot of stocks out there, but valuation does remain a concern. I mean go out to December 2026, estimated earnings per share here $1.21. Gives a target sell price at $20.09. So, I mean, it's more than what I would consider fairly valued at this point. I was a little bit optimistic here because I saw this past week the CEO was stepping down and it said the board is actually conducting a strategic review of the company and considering a range of possible alternatives such as simplifying the company's portfolio. Generally, I look at that as a buying opportunity because that's like, well, things are going poorly. We need to really focus on the company, get rid of non-performing assets. It can be we've made money off of buying companies in similar situations, but generally you get those companies when they're trading around 10, 12 times earnings, not 18, 19 times earnings.
That's much higher than 18, 19.
No, the future earnings are 18.
Earnings. Yeah, okay.
So I would just say, unfortunately, you know, the idea of why I wanted to look at it was, again, because I read that news and I was like, oh, maybe we could find something here on sale and they could do a, you know, kind of right size the company, fixate on good producing assets, but just not worth the risk at 18 times those future earnings at this point.
And this is the hard part for an investor. And that's probably why so many people are buying technology, because technology has the big growth, even though you're paying a lot for the valuations. Well, here you got a company that, you know, again, household and personal products, you know, Band-Aids, Listerine. You don't expect to pay such a high price for it, but it is at that level. And you shouldn't pay that high price for it because I think you'll regret it down the road.
Yeah, I mean, the theory is obviously it's consumer defensive where you shouldn't have a huge decline in earnings. There should be a lot more stability there. So sometimes people will pay up for that. But, we don't like to pay up for anything. So
No.
I wouldn't buy it here because let's say it's around 20 times future earnings and you're getting 7% or I'm going to say 5% long-term earnings growth. That really means you only make 5% a year.
Yeah.
I mean, it just, I don't think it's worth it at this valuation.
And we like to buy things on sale, and I think everybody does. I mean, you like to buy things on sale. You go in, you get a great deal on something, like, yeah, I got a great deal on this, I got it on sale. Who goes around and brags like, yeah, I paid 20% more for this product than it's worth? I mean, I don't know why people overpay for equities because generally you get burned on them down the road when you pay too much. People might say, oh, I can get out before that happens. Not really.